Introduction. 5 key market factors.
Hello, with recent volatility and post-election, we've added a little bit of additional content this month. 5 things we're watching. 1, earnings season, sector divergence, and equity market breadth. 2, when will yields finally yield, Uncle? 3, great expectations, looking at rate volatility expectations for 2025. 4, fact, fiction, and investment implication post-November 6th. 5, what's flowing at harvest, and enhanced equity income primer.
Earnings season, sectoral divergence, and equity market breadth.
Following the best first 3-quarter start since 1996 in the S&P 500, had the first negative month since April, closing down about 1% with equal weight down about 1.7%, and in both instances driven by the last day of trading for the month. Although it felt like the market was concentrated in the haves versus the have-not sectors, when we compare the best versus the worst subsector monthly return over the past 5 years, the market actually was more uniform than it felt, with the breadth from best to worst being relatively narrow. From a fundamental perspective, quarterly earnings have proven to be resilient. For the 435 companies that have reported thus far as of November 6th, revenue and earnings surprises have been above historical levels, and growth across the subsectors has been strong, ex materials, energy, and select industrials. Earnings growth has been positive, and the positive growth is not just in any one company. Out of the companies that have reported, almost 70% have reported positive growth. As we've talked about, seeing expanding earnings growth across the subsectors we think is very healthy, and the forecasts are now starting to come to fruition. Of course, some stock-specific events and of course pre-election jitters coupled with heavy bullish bias caused some volatility to increase, and expected correlations in the very near term also increased. This is with the backdrop, though, of a very meaningful uptick in longer-term bond yields.
Bond yields amidst rate cuts.
So the US Fed cut interest rates by 50 basis points in September. So why are bond prices down? They cut another 25 basis points as of recording November 7th at 3 p.m. Bond prices have been impacted by many factors. A key is the impact of bond yields of similar durations. For example, a bond that has a 10-year duration will be impacted by changes in the 10-year interest rate. The Fed controls interest rates at the very short end of the curve. The market, however, determines rates at different durations, say 10 or 20 years. These are driven by a lot of factors, but importantly, as inflation expectations rise because of strong economic data or potential policies, the yield curve will move up and down based on those expectations. From April to September, economic data had been decelerating quickly. This caused the market to have rates at the longer end move significantly down prior to the first rate cut in September. Subsequent to them, we've had bond yields move up significantly as economic data has been more resilient, coupled with concerns that policies in the US will be inflationary and lead to higher rates. For clarity, these are big moves in the yield curve in short periods. A 100 basis point move in the 20-year bond yield is equivalent to about a 16% move in the bond price of the same duration. So what does this mean going forward?
Rate and volatility expectations into 2025.
So that's what's happened for longer-term bond yields, but also expectations have changed quickly for the Fed to perhaps not cut as aggressively. Looking at a proxy for the market's expectations for the Fed funds rate, you can see that prior to the actual recent cuts, the market was expecting rates to come in at around 3% by the summer of 2025. Fast forward by only a month, and we now see that the expectations are that the Fed will only cut rates down to about 3.75. So what do we do with this information? Well, we remain at the pivot point as we transition from a hiking to an easing interest rate environment. And the 2 takeaways are: 1, directionality of Fed fund rates remains lower, and secondly, we in market forecasts are going to be very sensitive to day-over-day data, and that's going to translate to continued volatility in bond yields. That's been exacerbated by the elections. Of course, options are priced off of bond volatility, and we see bond volatility continuing. We need volatility to stay at elevated levels to generate premiums. However, with the economic and political backdrop we just talked about, we see that volatility continuing. We've continued to see significant inflows into our HPYT and HPYM, our longer dated bond ETFs with covered calls, and continue to generate cash flow on a monthly basis amidst this high volatility.
U.S. presidency and post-election realities.
There are things that we know, and then there are things that we know we don't know. We know that the Republican win for the U.S. election exceeded most expectations, and that the wins in the Senate and presidency put the Republicans likely firmly in control of policymaking for the next 2 years. In politics, however, there's a lot that's said. However, there's a distant relationship between what is said and what is actually done. The general narrative coming into this election was Trump's draconian trade was going to drive massive inflationary pressures, cause major upheaval in world trade, and result in yields gapping higher. On the same side, deregulation will be driving windfall profits for banks, energy, and select healthcare companies. Look, every new presidential term starts with speculations about the winners and losers in the markets. However, let's look at history. Take Trump's first election win. Deregulation and energy were amongst the biggest expected movers on banks and energy stocks. Drill, baby, drill. Yet, you had got the worst performing sectors during that presidency, energy and financials. On style, small and mid-sized value companies were expected to outperform, and guess what was best? Growth. Goes on, under Biden, energy was supposed to be crushed by renewables. Yet, top performing subsector, energy. Going back further, under financials with Bush, they were all supposed to benefit from all that deregulation. But we remember 2008. Under President Obama, ACA was expected to be a huge win for healthcare, and utilities were expected to benefit from the renewables. Yet both lagged. Point is this: there may be a bit more durability in the policy initiatives giving the overwhelming majorities, but again, that's a maybe. Just like pre-election, post-election, there's rhetoric, lots of content, but I think we're best served focused on diversity, fundamentals, where we're at in the economic and yield cycle.
Featured Harvest ETFs.
A quick update on where we continue to see the most amount of inbound inquiries and recent flows at Harvest. In equities, we had a number of inbounds on healthcare and HHL specifically. We'd note from a sector basis that the geopolitics are very muted. Within the sector, there were more stock-specific catalysts over the past month. We've detailed a number of these in our monthly commentary, including comments on GLP-1s and managed care. HUTL and utilities, and similarly in REITs, continue to be a focus for those looking for more defensive attributes on a global scale. You can also check out our Insights page for some recent articles. In fixed income, both HPYT and HPYM continue to see sizable inflows following the backup in rates through the end of the month and the elevated volatility driving premiums. We've outlined a number of the drivers today, and of course we also have some insights on our website. Lastly, we've had a number of inbounds looking at a recovery post-election, looking at enhanced ETFs. Enhanced ETFs are those that are looking for modest leverage of about 25%, and they can now do so in their non-registered and registered plans at institutional rates. Be aware, by having 1.25 times the income, you also have a bit more volatility in down markets, and that the leverage ratio is also maintained at 25%. We have a diversified, a balanced, and several sector-focused ETFs that employ 1.25 times leverage for those looking for enhanced income.
Subscribe to Harvest ETF's Insights. Join us and stay informed.